Good morning, everyone. Morning. Hopefully everyone's awesome and well. We've got a few of you guys jumping in now, which is awesome. Pop out that chat. I can see. Oh, great. Thanks, Alison. Thanks for the shout out for the session last night. Yeah, it was good to catch up with you guys and do the do as we do. Yeah. Well, good morning, everyone. Morning to all of you guys jumping on there. I can see you guys flying on in there. It's Simon and Sharon and Nicole, Natando, Nick, Ben. Good morning, mate. Good to see you. A few people jumping on. That's awesome. All right, well, good morning. Good to see you. Welcome to another Wealth Coffee Chat, 17th of August, as we're rolling along here. 17th of August, it's a Tuesday. There you go. Feels like the end of the week already. But there you go. Hopefully you're awesome and well wherever you are. Christina's got some good vibes going on. Nicole's got some coffee. And away we go. So thanks, Pritesh. Thanks for the shout out, mate. That's awesome. Glad you guys enjoyed last night. It's always awesome to hang out with you guys and do what we do. Like I've said a few times, I love what we do. Really enjoying it. Roz is up there on the sunny coast. Margaret, good morning to you. Fantastic. Good to see all of you guys jumping on. For those who haven't met me before, Jason Witten's my name, and been property investing over 20 years. Coaching property investors since 2003. And along the way, paid attention, learned a few things, done a few deals. And each morning, we get together like this and have a quick chat, maybe 10, 15 minutes, and just share a little bit of some of the learnings that we've had over the years. Myself, Sam, Tab, and the team along the way. So thanks for joining me. Awesome to have you guys here. Welcome to the Morning Wealth Coffee Chat. If you're new, give us a shout out in the chat. Say new or say hello or something as we go. Rob's there. Rob, how about morning, mate? Alison, thanks for your question. We'll circle around, see if we can't get back to that one soon. There is a little bit of rhetoric going on when it comes to the media, but you know, that's nothing new, is it, team? When it comes to the good old media. Anyway, let's do this morning. Hey, this morning I wanted to chat to you guys about some of the ways we can look at the analysis of our investments. And we can say, all right, well, is our money working hard enough when it comes to our investments? How do we analyze? Compared to what? There is some rhetoric out there in investment land, you know, cash on cash return, gross yield, net yield. How do we analyze as property investors? How do we analyze we're getting the most out of what we need when it comes to our real estate? And I'm going to try and cover it as an overview today, but maybe as you go through your journey, start to analyze and understand what this means and what it looks like. And the best way to do it, team, is to do a quick snapshot on a piece of real estate that we've got here. And let's have a look at what it might look like to own this bit of real estate and the returns, the dollars and cents that we might get out of it, right? So you guys are sitting there going, all right, well, I own a bit of real estate. Maybe it's like this, maybe it's not. I'm using the example today of a $550,000 property and some very rough, simple mathematics when it comes to where we're at with our expenses and other bits and pieces. Okay, so let's have a bit of a look. To have a look at gross return, net return, return on cash on cash return, internal rate of return, blowing my mind up. Confusing. What does it need to look like? So let's do a quick example. And start the conversation that way. What we've done and what I've done this morning, hopefully this works. There we go. We've got ourselves a loan for $450,000. And in this example, I'm going to use the $100,000 as a round number, and we've put cash into the deal. Let's say we've saved up and we've put cash, hard-earned dollars into the deal. Now, if we use equity, team, and I'll show you in a minute, our cash-on-cash return gets better and better. But let's just talk about that, right? So we buy this property for $550,000. We put $100K cash in, and we can get $25K rent off that property. Now, there's some rough expenses here. That's the interest only. And over here, we've got some costs when it comes to rates, insurance, and so on. All right, so just rounded that up to $5,000. Might be a bit more, might be a bit less. And our net outcome, team, is $20,000, okay, of expenses. So how do you do that? Quick mathematics, you minus 25 from 20, and you end up with, if you look at it, we get a positive cash flow here before tax of $4,250. Now, I've done interest only, team. I've done interest only at 3%. Now, you could do it interest only at 3.5. You could do it principal and interest of 1.9. But just follow along. The numbers aren't, this is not about the exact numbers today. This is about the theory of the concept, what we're talking about. How do you measure, is your property performing? Is your money working hard enough for you as a property investor? And then you go compared to what? Okay. We got a positive cash flow return, cash in your pocket. Awesome. Not only that, the cool thing about real estate, and certainly at the moment it's even more cooler. I don't know if that's the right English, but anyway, you can make a positive cash flow and you can get tax back, because on paper you get depreciation. I've talked about that. I'm not going to do that today. You get some tax back as well. So the net cash back in your pocket is a nice chunk of $9,250. You beauty. Okay. Now, that is the cash, and depending on how you want to treat it, that's the real cash back in your pocket for owning that bit of real estate. Okay. Now, gross return is calculated on the rent. Okay. So the rent as a function of the price. Okay. Now, the gross return at the beginning is perfectly fine, but it starts to devalue over time. I'll show you what I mean by that. So the gross return here, if you have a look at that, that's close enough to 5%, okay? So your gross return is 5%. Now, in reality, that means 2/5 of nothing to us, to be honest, because it's not really giving us any indication of is our money working that hard. Basically, that's just a ratio of the rent to the purchase price. So that's fine. That's a 5%, like between a 4 and 5% gross return at the moment around Australia is perfect. It's great. 4% probably in Melbourne, because Melbourne's rents have always been a bit lower, and you're looking to 4.5 to 5% in Brisbane. That's kind of and then Sydney's kind of like a 3.5%. It's ludicrous. The rents in Sydney are terrible at the moment. So, team, what happens is when you rent this property out, you've got some expenses, okay? And that comes out as a gross, and you minus these expenses, and you end up with a net return of 4%. So everyone's following along. Like, usually, if you're looking at your properties, team, you're looking at your cash flow, and if you look at a quick snapshot analysis, 99% of the time you have a bit of a look at, all right, if I'm getting 5%, it's usually 1% for my costs. My net will be 4%. That's usually how it works, team. Okay? So just keep that in mind as we go along. Maybe be a bit conservative, 1.5 if you're an apartment or a townhouse, and maybe 1% if you're a house, okay? Because you've got some expenses there. Okay, so 5% and 4%, what does that mean to us? Well, 2/5 of bugger all, really, other than it's just a good starting ratio of an analysis to buy the property. But what happens, team? What happens if our properties go up in value really quickly? So let's say this 550 now becomes 650, And that's quite possible right now. Many of us have experienced this. If you have a bit of a look at the marketplace right now, you go, all right, well, let's have a look at my property price going up $100,000 in, let's say, 18 months or 2 years. What happens to our gross return and our net return? So check this out, team. Because rents don't go up as fast as property prices, if it's $650 now, right, your value, or you purchased that property at $650 with the same rent, now your gross return is 4.4 and your net return is 3.4. The rent is the same, but what happens as your property price goes up in value, often your rents as a percentage yield reduces. Okay, that's what's called yield compression. I don't want to dive too deeply into that today, but hopefully you guys are following along. So give us a shout out in the chat if it's too complicated here, or you're following along. So just give me like a thumbs up, Jason, or yep, yes, or whatever. So I know this is landing for you, because then we go, my property's gone up in value, and now the net yield's only 3.4%. Is that a good property? And you start to second guess yourself, okay? And the answer is, it's still perfectly fine. It's no problems. It's not an issue, because this is not a great way to measure the success of your real estate. Gross and net returns, they're kind of pointless, to be honest. Let's have a look at the best way to measure our success when it comes to, am I getting the most out of my bit of real estate? Return on cash, return on capital, what does it look like? All right, so let's have a look at this. What are the 3 ways we can get a return on a piece of real estate? Okay, number 1, you can get the rent. Number 2, you can get some growth. And number 3, you can get some tax back, okay? And what you have to do is you have to analyze those 3 as a cumulative amount to have a look at, is your property performing? Are you getting a return on what you're doing? So let's have a look at this. Let's say you got $25,000 of rent. Let's say you had $25,000 of growth, okay? And let's say you got $10,000 worth of tax deductions, okay? That would equal $60,000. Okay, so that's $60,000 of value created by this piece of real estate. That's created by this bit of real estate. Everyone following along? So tell me, team, how much money did we put in to this piece of real estate in the first place? $100,000. We're getting a return on capital, or cash on cash return of $60,000 of net value, added value to your position. Now, we're not talking cash flow here. We're not talking any of that stuff right now, because cash flow is a function of your expenses, and expenses go up and down, okay? Your interest rates go down, your interest rates go up, okay? Over time, you'll have less debt, et cetera, et cetera. What we're doing is saying, we put some cash to work. This is our cash. We put $100,000 to work in this piece of real estate. Is it working hard? What's our cash on cash return on my bit of real estate of the money I've got in there, or the available equity I have in there? And team, $60,000 divided by $100,000, what percentage is that? Tell me, team, in the chat right now, what percentage cash on cash return divides 60,000 by 100,000? That gives us our percentage return. What's the return? Tell me that number in the chat while I have a little sip of my coffee. Anyone good at mathematics? I know there's a small delay in my thing here, so to pad out, maybe I'll do a little tune or something like that. There we go. Chris is on it. Boom, Chris. 60%. Team, check out that. Now, if And let's say we borrowed at 90%, team. Let's say we were borrowing at 90%. That's our 60% return. Let's say we had to put 200,000 in, 200K in, team, instead of 100,000 because your broker was lazy or stupid or useless. Someone at the bank said, it's easier if you borrow at 80%. Let's say we put 200 grand in. What return would we get then? If that was 200K, it'd be 30%. Okay? And so on. The more cash you put in, we're measuring the cash or money, equity that you've put into a deal that is working out for you. Okay? That's the measurement, team. That's the measurement. The money you've got in the deal or the equity in the deal, how much return on equity are you getting on that deal? Okay? And I'll circle around on this one and have a quick leave you with this idea. Okay? So, and here's the thing we talk about, myself and Sam talk about all the time. Now your loan is 300, and now this is worth $1 million. All right, let me do this. 1 mil. Okay. And you've got 700K here. That's a house, by the way. You've got 700K here. Now, the property, because the rents over time detach from the property value, okay? They don't keep up as much over time. In good locations, they can keep up a lot better. The city locations, better located properties. But let's say the value's detached from the rent. This is the opportunity in here to put this money to work because now technically it's lazy. We got lazy money. Even though we're wealthy, on paper, we have paper wealth, but our money is lazy. We've got all this wealth and it's not producing anything tangible. It's all paper value, okay? We don't have access to it. And this is where we talk about the idea of equity arbitrage. Arbitrage. I think it's spelled like that. I think there's an I in there somewhere. Arbitrage or acceleration strategies. All right? Acceleration strategies. Now, this is the way we analyze our properties, and when our return on capital, our cash on cash return gets too low sitting in the existing property. I'll get rid of that. Sitting in the existing property team, when our cash on cash return, our return on capital gets too low, we say, all right, what can we do now? Because the rent plus the tax deductions is slowing down. How can we now accelerate? How can we now use that property as a catalyst for better and more and faster income? That's an important question, okay? Because a lot of us get caught often when you talk to, let's say, a financial planner or an accountant going, oh, your gross yield or your net yield now is 2% on that property. Oh, it's rubbish now. Your time to sell, right? Like, no, don't sell. Use the equity in acceleration strategies in a smart way. And if you don't know what I'm talking about there, reach out to your coach, have a one-on-one meeting, because you guys know we do a bunch of acceleration conversations for when you're ready, okay, in that sort of stuff. So there you go. Anyway, hopefully that makes sense, team. Did that make sense today? Hopefully that landed. Cash on cash return, return on capital. How hard is your property working for you? And is there a chunk of lazy equity or lazy capital not working hard enough for you? Analyze cash at work. How much as a percentage of equity and capital do you have available sitting in your world is at work? Okay? It's a good question to have. So hopefully that makes sense, team. as we go along there, and we'll jump in there and have a little look at a few other things as we roll through the week. But there you go. Had a couple of questions here. Alison was talking about Reserve Bank tightening interest rates, and lending in high LVRs. I'll circle around on that one in the coming days, Alison. For the moment, I don't think there's going to be too much problems, but certainly the conversation is at the moment about trying to slow the market down. I think the market will slow down perfectly fine on its own right now, but we shall see. But I think there's plenty of pressures in the real estate game right now that are going to keep it floating along. So as we go, and Jasmine talked about some share stuff, and yes, absolutely, Jasmine. I'm planning on getting Andy Fenton on Wealth, Wine and Wisdom to come and talk about some of the other alternative strategies, and it's good to think about spreading a little bit of that investment concept around, and shares sometimes is an attractive option when it comes to that stuff. So, I'll get them on as you go. And Chris, you nailed it, mate. Yeah, if you can get your deposit back, team, your return becomes infinite. Like if you get your cash back, your return becomes infinite. Your cash on cash return. And then, Chris, it comes to the one that I didn't even get to today, which is called an internal rate of return. So now that property's given you your money back, so you technically haven't got any capital at work in that property, which is awesome because you take the capital and you go get another one, keep working the capital. Now you say that property standalone, its internal rate of return, its own ability without any stimulus from me as the investor, what return am I getting on it? And that's where we start to see a return on the equity, the return on the rent, return on the value on that property. So awesome to hang out, team. Hopefully that made sense and it landed for you guys. Always happy to answer your questions. If you got them, leave them in the chat like Alison and Yasmin did. And I can circle around on a few of those as we roll along. But other than that, Wealth Coffee Chat done and dusted. You guys are awesome. Thanks for hanging out and have an awesome rest of your day. Join me tomorrow around about the same time. And for those who want to see the replay from last night or missed mentoring last night, it'll be up by Friday in Positive Mentor, our online learning center, as we roll. So, all right, team. Awesome to hang out. You guys have an awesome day and see you tomorrow.